Welcome everyone. Today we're diving deep into a fascinating 360-degree analysis of Samvardhana Motherson International Ltd. We're going to look at how this company grew from a single plant back in 1986 into an absolute global automotive component behemoth. If you follow the auto ancillary space at all, you know Motherson is a heavyweight. So today, we're unpacking their numbers, their technicals, and their future strategy to see what really makes this business tick. Okay, let's dive right into this explainer. Here is our roadmap for today. We're covering their business model and moat, financials and valuations, shareholding and technicals, their EV and future vision, and finally wrapping up with valuations and broker targets.
Section 1, Business Model and Moat. Let's understand the core of how they actually make their money.
So their biggest strength, their real economic moat, is this brilliant 3CX10 strategy. It's basically a strict risk mitigation policy ensuring that no single country, customer, or component contributes more than 10% to their total group revenue. By deeply diversifying their customer base among global automakers, they fundamentally wipe out customer concentration risk. If one region or one specific automaker hits a speed bump, Motherson's overall revenue is heavily protected. It's a real game changer for stability.
You can clearly see this strategy playing out across their core revenue streams. In wiring harnesses, they are the undisputed market leader in India and a top player globally. For vision systems, they actually dominate the global market share in exterior rearview mirrors, and they're also a major supplier of lightweight polymer modules for interior and exterior parts. But here is what's really interesting: their rapid expansion into emerging businesses. They're aggressively moving into aerospace, health, and medical and consumer electronics. Just to put that into perspective, their aerospace order book alone has already crossed the $1 billion mark. That is organically boosting their overall segment margins.
Moving right along to Section 2, Financials and Valuations. Let's look at the hard numbers.
So their market cap is sitting at over 1.6 trillion rupees, which makes them an absolute giant compared to peers like Bosch or Uno Minda. Now looking at valuation, the trailing PE ratio is at 41.5 and the PEG ratio is 3.5. A PEG of 3.5 basically implies that the stock price has currently outpaced its recent earnings growth. However, their estimated EV to EBITDA for FY26 is comfortably placed at around 0.7 times. When we look at their capital utilization over the last 3 years, it's solid. Return on equity is 12.5% and return on capital employed is 13.1%. Plus, we're seeing consistent improvements in their CFO to PAT ratio and working capital cycles like inventory and debtor days.
Now you might be wondering, why is the market giving them a premium valuation? Well, the answer lies right here, in their recent growth trends. On a year-over-year basis for the March quarter, net sales crossed a record 34,309 crores. That is a robust 17% revenue growth. But the real standout? Profit before tax surged by a massive 87.24%. When you track their profit and revenue growth over the last 3 years, it clearly shows that management is successfully turning around previously acquired, underperforming units and drastically improving the bottom line.
Considering all the global acquisitions they've made recently, you'd probably expect their debt to be sky high, right? Well, check out this number, 0.47. That is their debt-to-equity ratio. Despite their relentless inorganic growth, having such low leverage indicates extremely disciplined balance sheet management. It basically tells us they've got plenty of dry powder for future acquisitions without stressing out shareholder equity.
Let's shift gears to Section 3, Shareholding and Technicals. We're going to check out ownership structure and market momentum.
Looking at the shareholding pattern, promoters hold a very solid 48.6%. But the really strong indicator here is the institutional backing. Domestic institutional investors, or DIIs, have bumped up their holding to almost 21%, while foreign institutional investors hold 12.6%. That combined institutional ownership is over 33%, and it's been showing a steady upward trend over the last few quarters. You know, when the smart money holds a third of the company, with that level of analytical confidence, it provides incredible stability to the long-term growth story.
Reinforcing that confidence even further is the pledged promoter shares number, standing at just 2.9%. Generally speaking, anything under 25% pledging is considered the safe zone, so 2.9% is practically negligible. For long-term investors, this is a massive green flag, showing that the promoters are not financially overextended at all.
On the technical side of things, the price action shows tremendous momentum. Trading at around 151 rupees currently, the stock has delivered a return of over 50% in just the past year. If we analyze the daily and weekly charts, the price is currently trading in a sideways consolidation channel right near the upper trendline breakout resistance. It's maintaining its position well above its 20-day, 50-day, and 150-day moving averages, which points to a very strong underlying trend. If it decisively breaks out from here, the chart pattern suggests a meaningful upward move could be on the horizon.
Section 4, EV and Future Vision. Let's unpack their Vision 2030 roadmap. Management's Vision 2030 roadmap is, quite frankly, incredibly ambitious. They are targeting a staggering $108 billion in gross revenue. To put that in perspective, that requires a massive 33% compound annual growth rate over the coming years. Alongside that, they're aiming for a 40% group return on capital employed and plan to distribute 40% of their consolidated profit as dividends. But step 4 is the real kicker here. They are progressing from just supplying integrated assemblies to doing full vehicle assembly. They essentially want to capture value across the entire automotive supply chain.
And how are they executing this? Through their EV readiness and an aggressive acquisition engine. The EV segment already accounts for 11% of their total revenues. As the industry shifts from internal combustion engines to EVs, Motherson's content per vehicle actually increases. For example, the wiring harness content in a four-wheeler EV jumps by 2.4 times compared to a gas car. Add to that, they've successfully acquired and integrated 15 different entities just since September 2022, and the data shows that their acquisition ROI and synergy realization have been remarkably strong, proving their knack for integration and margin improvement.
Finally, Section 5, Valuations and Broker Targets. Let's see what the institutional analysts are saying. Let's impartially contrast a couple of major institutional outlooks. Both Motilal Oswal and Nuvama have slapped a buy rating on the stock, but their price targets differ quite a bit based on timelines and EPS estimates. Motilal Oswal set a target of 160 rupees, primarily seeing the company as a huge beneficiary of rising vehicle premiumization and the EV transition. On the flip side, Nuvama has a target of 110 rupees, focusing more on the 23% CAGR driven by their diversification into emerging, non-auto businesses. This clearly shows that while the market consensus is undeniably bullish, expectations around the speed of value realization definitely vary.
So what's the so what behind these bullish targets? Well, these global megatrends are playing perfectly into Motherson's hands. When a consumer buys an SUV instead of a small car, or an EV instead of a gas car, Motherson simply supplies more components. SUVs require about 1.5 times more wiring. Rearview mirror complexity jumps by 3 times. And as we just mentioned, EV wiring content skyrockets by 2.4 times. This means that even if global auto sales volumes stay completely flat, their increasing content per vehicle directly generates significantly higher margins.
So, as we wrap up this explainer, I want to leave you with this thought. Samvardhana Motherson has massive global scale, low debt, and an incredibly ambitious Vision 2030 roadmap. But with a PEG ratio of 3.5, the market has already priced in a lot of this anticipated growth. Will they successfully execute that $108 billion vision? Or will the integration risks associated with so many aggressive acquisitions in a cyclical auto component sector eventually outpace shareholder value creation? It's definitely a compelling story to monitor closely. Thanks for joining me for this analysis. Keep learning, keep analyzing, and I'll catch you in the next explainer.